Thank you, everyone, for joining us once again for the monthly chart book that we'd like to walk through with you. We hope you enjoy this and we'd love to hear your feedback. Let's start with the stock market performance. As you can see, despite the bear market this year, the stock market has rallied significantly over the past 2 years. Markets remain uncertain due to inflation and Fed and tech stocks and potential layoffs and everything that goes along with a recession. But for the long-term investors, it is really important to maintain the proper perspective and look past the short-term volatility. One of the things that I really wanted to take time to point out was with regards to the stock market moving averages over the last few months. As you can see, when we look at inflation right here, the fear begins when the discussions around inflation started to talk. Now, this is not something that we didn't anticipate. We were actually looking at the fact that inflation was likely to happen. What this particular chart tends to show you is that when we look at moving averages, there's basically the 50-day, the 100, and the 200-day that we like to look at. Are they starting to consolidate? Are they starting to show a trend? The 50-day moving average shows how the market has been behaving recently, while the 100 and 200 shows a much longer term trend. If you look at the 100-day, it's very interesting right now. If you follow that red 100-day, you'll notice that there's actually a slight tick up. That's something I'm watching very closely. Another item that we look very closely at tends to be the historical average or the average of the stock market price to earnings ratio. It was actually a little bit cheaper last week than it is this week when I compare the two side by side. But what we're looking at right now is the historical average. So looking back over the last 40 years, basically, the historical average has been 15.5%. Right now, it's trending very close to that historic average. What we'd like to see is it dip just a little bit. So if it could go below the historical average, then it could be an indicator that stocks are valued or on sale. If you've listened to me in the past, you've seen this particular chart. You'll notice that it continues to show that negativity for this year, of course. But one thing that I just want to reiterate, because if you haven't heard me before, you don't know this, is these blue bars are the annual returns. So if you looked at investing from January 1st to December 31st, this is where the returns would end up for that particular year if you held for the entire period. Now, if you invested in 2022 in January 1st and held it as of right now, you'd be down about 21%. The red dot is the maximum drawdown. Now, the maximum drawdown says what's the biggest decline in intra-year, basically. So when you look at the averages of all of the positive returns, the average is around 9%. If you look at the averages of the negative returns, the average is about 13.5%. That takes into consideration this aberration of 49% down, or actually ended up 38% down in 2008. As you've heard me say before, volatility is just a normal part of investing. And even in good years, we can see negative returns at some point in time throughout the year. Now, I know if you're a client of mine, you've definitely seen this chart before. And one of the things that I really want to stress is this goes back to World War II. It is I would say a market correction and recovery average, right? The dark blue line is the average, and the light blue lines are all of the different corrections. Peak to trough is what's showing here, and you can see the average market correction is about negative 14.3%. As you saw by the prior chart, we've actually seen as much as 25% down this year, and it took about 6 months to get to the actual trough. Came back a little bit during the summer, came back down to the trough. So we'll see, how this market is tested again. I think it's going to be over the next couple of months. Of course, there's a time in between where the market is very uncertain, but historically looking back, when the actual bottom hits and traders start to buy, the recovery on average, and I can never guarantee any of this, of course, but the recovery on average takes about 4 months. So from the very, very bottom to the return to the peak, the old peak, usually takes about 4 months in total. On the other hand, when you're looking at a bear market and the recovery, again, this goes back to World War II. Bear markets are peak to trough with declines of 20% or worse. This is what we're in at this point in time. The bold line is the average across bear markets. So if you look at the market average, is a decline of 34.7%. That's the average bear market going back to World War II. And then the total peak to recovery period, it takes about 2 years. So if we think about that from a standpoint of where we're at right now in things, if it takes an average of, let's say the crash happened, if you want to call it that, that's just the terminology that they're utilizing in this particular chart. But let's say that still takes about 5 to 6 months, then you would be looking at about a 2-year recovery from the trough to the peak. If you flip back to that slide for a split second, you'll probably notice that it was quite a trajectory upwards. So although it took 2 years, it did start to recover. And if you stayed in the market during that period of time, you historically would perform better than if you tried to time the market by getting in and out. So this particular chart I always like to show again because it shows the benefit of staying invested during any kind of market. So this situation is over the past 25 years, if you had initially invested $1,000 and you stayed invested during all the corrections that happened or the bear markets that happened in the past 25 years, then as of Monday, or Friday, excuse me, your balance would have been around $3,700. So you would have gained almost a little over 3.5 times what your money that you put in. However, if you just pulled out and missed the best day, just one day, that's it, then your value would have been about $400 less. And if you do what a lot of people tend to do is they'll pull out of the market when it's volatile like it is right now, and they'll wait until things calm down, which could be anywhere from 20 days to 40 days, because the recovery tends to happen in hindsight. And what I mean by that is we don't know when the bottom actually is going to be declared and we're going to start to buy rapidly. So if you look at that, if you had waited the best 20 days of any particular market recovery during that period, then you basically would have $1,000 left. So, and that's if you captured other good days in the market, because you can see if you missed the best 40 days in the past 25 years, then you would actually have about a third of the money that you invested, a little less than a third, actually a little less than half of the money that you invested. Switching gears just a little bit, you'll notice I've brought this up a couple of times, but interest rates, we're still looking at an inverted yield curve where the 2-year Treasury is still outperforming interest rate wise the 10-year by quite a bit actually, and we're going to continue to watch that and see when it starts to pull back. This is why we're telling everybody to keep things fairly short in maturity level right now, especially for new purchases. We think the Fed is going to continue to raise interest rates, as they've said, and we'll be able to capture some of the upside. Eventually, we'll see this crossover and we'll start to invest in the longer term. Wrapping things up with a couple of economic indicators. This particular chart that I'm showing you is a year-over-year percentage change in the index of leading economic indicators. Notice that if you look at the end of this chart, it actually has turned negative right now. The indicators usually turn negative several months before a recession actually hits. And if you look at this, you'll see that it's pretty evident over the prior 7-year sessions that when this indicator hits negative, that an actual recession or economic declining cycle has happened. We're also starting to see a fairly good decline in consumer spending. So when you look at the non-store and the retail spending, we are starting to see this revert back to the more average growth. I suspect later into 2023, you're going to see this fall below the average, especially if the Fed continues to raise interest rates at the rapid rate that they want to. They want to see inflation around 2%. So that's going to take some additional work. And finally, we just wanted to share some information on building permits because that has certainly slowed down. We've seen new privately owned housing units authorized a significant decline over where it was at the same time last year. More reverting to the average, but it's still got a ways to go, and we think it's going to continue to trend down. And when you look at existing home sales, that has certainly declined from its average as well as from its peak in January of this year. That certainly speaks volumes. And historically speaking, when we're seeing a lot of home sales turnover, that is a good sign of the strong economy. With interest rates being so high on mortgages and, just thinking about some of the other reasons why people aren't moving, fear of potentially losing jobs, those kinds of things. We've seen a very good slowdown in this particular market. And before we let you go, we just wanted to mention or throw this chart up to show you the stocks and bonds annual returns. And I know you've heard me say a couple of times that this is an unusual bond market. When you look at other periods of times where there had been rate hikes, you do not see the bond market falling to the rate that it historically has, to the rate that it has this year historically. The worst we've seen, in other years is a lot less volatile. And so far this year, the stock market is down 20%, but the bond market is actually down a whopping 16%. And again, when you look back historically, that is not what we've seen when interest rate hikes have happened. I personally believe that it's because more people are trading in their own accounts, have the ability to sell, and they're selling on fear, just like stocks sell on fear. That's my own personal theory. But I hope you have enjoyed these particular set of slides this time. Again, sorry I ran a few minutes over. We hope that if you have any questions, you will bring them to our attention, and stay tuned for next year.